Hello, everybody. Thank you for joining this webinar, right, on investor stages and what to expect there. My name is Kevin. I know a bunch of us have talked together in the past, right? A little bit about me. I'm actually currently already raising funds for my company. I've done so in the past already. But before this company, I had a small tech and hardware startup, right? We did $4 million in sales and we were asked to approach for acquisition. So this kind of goes within my wheelhouse. So I've got some experience in this, but of course, others who've also raised money in the past can also weigh in during this period of time. And the first thing that we're going to kind of list while we're going ahead with this is when you're raising funds for your company, the first thing you want to do is you want to figure out who you want to approach as an investor. We're going to talk about how to approach the investor, what to look out for the investor, right? What are the first steps, second steps, third steps, and ideally, right, at the very end of that, you get a check in your hand, and what are the steps after that check? So the first thing that we're going to do is we're going to talk about, even though it's not really part of the investor step to step itself, it is like the first step, which is finding the investor itself, right? Joining the founders group is a very good first step, right? You're with a lot of different founders. And the caveat to this really is that you want to recognize, that every single founder they're working on something different. So their investors may not be the correct investors for you. But how do you know? A lot of times what this will happen, how this will happen is you're going to do a little bit of due diligence on your own and do some research on the investor itself. You'll want to see their previous investments, see if they align with yours. But something also to kind of note is, have they invested in a company that does almost the exact same thing as you? And are they actively still invested in that company? Because if that is the case, do you want to bring attention to yourself in that sense, right? So say you are selling, in my case, right? In the past, I sold like a fireworks firing system, right? Didn't really get approached by a random company at that point for a buyout. But if I were to approach another company and another investor for that, but they also had invested in the past in a company just like mine, would that be a conflict of interest there, right? So you want to kind of look at the investor itself and you want to take a look at what they've invested in the past. You want to take a look at their thesis. Do their check sizes align with what you're looking for? A lot of times check sizes, they'll inflate their check sizes, right? So they say we invest up to 3 million. They may mean that they regularly invest 3 million into companies, but likely it means that we're comfortable investing 3 million, but that is the most we've ever written before, right? So you want to kind of like dig deep, take a look at the investors you're talking to, what their investment thesis is, what they've done in the past. Could you, if they're not investment companies, could you approach an individual? What have they done in the past, right? Likely, like sees like, right? So if you're a company that does something in tech, in apps, you want to look for investors that have perhaps created their own application before, and you'll be able to see eye to eye there. So the next step after that is to reach out. Likely, hopefully you'll have a warm introduction from somebody. So what you can do on LinkedIn is take a look at the people that invested in the past, right? See who they connected to, see if you have mutual connections. If it's like an old high school friend, all of a sudden you're going to reconnect with a high school friend. You're going to say, hey, how you doing? I saw that you're connected with this person. I was wondering how you're connected to them. Do you mind making a warm introduction? You're more likely to get a meeting at that point for that person, right? After the warm intro, you're going to schedule a pitch. In the founders group, this is wonderful because you get to practice your pitch beforehand. If you don't know how to get that scheduled, please talk to Adam, right? He'll help get that set up. But you're going to want to practice your pitch beforehand, right? You're also going to slightly tailor your pitch to the investor at hand as well. But given you may know what their interests lie, if their LinkedIn talks a lot about dogs, like a lot of us here like dogs, right? Talk about the dogs. Make a little you're likely to invest in people that you like. So you want to make yourself very presentable, very likable, and start with the presentation. So after the presentation, after your pitch, what's going to happen next, right? Likely, what happens a lot is the person nods their head and says, "This is very interesting," and they'll hang up. After they hang up, you'll get either usually during the pitch, you'll ask them what their process is. And a lot of investment companies or investors or investment groups, what they'll do is they'll have a weekly meeting. that they'll say, hey, we're going to go over all of our pitches for the last week, and we generally meet on every Monday, Wednesday, or Friday. It likely goes on Monday or Wednesday a lot of times, just because Friday, no one likes to really think about stuff after that Friday. So they'll have their meeting on Monday or Wednesday, of which they'll talk about all their pitches, right? Yours may come up, yours may not. If yours does not ever come up, you'll likely hear about it a day or two right after the pitch. Hey, great pitch. They'll never really tell you any feedback at that point. They'll say, hey, that was a great pitch. It's just not in our wheelhouse. Thank you very much. Of which you're free to then ask them if they have any feedback for you. A lot of times they don't like saying no. They don't like saying that the pitch was bad or anything like that. They may just simply say, hey, that wasn't in our wheelhouse, but we wish you luck. Or they'll say something along the lines of, that was very interesting. Please keep us updated. What do you do with that? If you're doing regular investor updates, include them in the investor update, right? If not, keep them updated. If you really want that particular investor, definitely keep them updated, right? But generally speaking, that is a no, right? And you kind of move on with your life. A lot of times you're going to be having up to 100 of these pitch meetings, just depending on how much money you're looking for, how much money you're raising, and your investment strategy, right? So please don't be discouraged. A lot of times it's like applying. I mean, it's like applying for a relationship. It's like a relationship. You're asking for a marriage here, right? You want to make sure that you like them, they like you, they think they can work with you, you think you can work with them, so on and so forth. So definitely don't get discouraged, right? But on the off chances, or in some cases, on the very particular chances that they come back and go, hey, that was a really good pitch. What is the next step? What do we expect? And this is kind of the crux of this webinar, is what are the next steps after that, right? The steps are usually due diligence. Here's why we highly do not recommend doing product demonstrations during your initial pitch. Because product demonstrations are usually done during the due diligence phase. When you pitch your idea, your product, your current business, what will happen is you want to be able to pitch the problem and that you are the solution. Not necessarily to prove that you already have the solution, but that you are a solution. The problem is big enough and your solution is purposeful enough for you to solve that solution. Investors do not want to get bogged down on the product demo. Sometimes they will ask for it during the pitch, but that is rare because you generally only have 15 minutes. And if your demonstration takes up 8 minutes, you don't have a lot of time to prove your point. But you want to avoid your product demonstrations in the initial pitch because, again, it is during the due diligence calls that you will be doing the product demonstration itself. Why is that? Investors themselves are not generally the product expert at their VC firm. This is because their intent is to screen these calls to ensure that, hey, this is a compelling story. We may want to invest. The next step is they're going to assign a junior that may have experience in your field, in your tech stack, or anything like that to go in and do the due diligence on you. Show me the product. Show me what it does. Make sure that it doesn't crash, so on and so forth. That's one of the steps of these secondary calls. However, going back to the pitch itself, what if your pitches and you're pitching yourself and your team, and a lot of times, generally in our founder space, a lot of us we're coming in really idea first. So you're pitching yourself. Your pitch is really, I have an idea and I can execute. What does that mean for due diligence though? You may not have a product to show the investor at the end of the day. What does the due diligence look like at that point? Well, in your pitch deck that you've likely sent to the investor, you may have your team slide, where you went to school, maybe not, but you'll have something there that the investor will want to do due diligence on. It might be you as a person. What they might do is they might try to look at your LinkedIn, look at the context within your LinkedIn and the people that you've interacted with. They may call the people on your deck. So if you have already like traction or clients, their due diligence is going to be, hey, can you please give me the contact details of the people you put on your pitch deck? We'd like to talk to them. We'd like to see who you are from their eyes. Are they easy to work with? Is what they're saying is true? I'll give you an example here. So on my pitch deck, I have my advisors as well as my current investors, some of my current investors on my pitch deck. I fully expect and have already briefed my advisors and my current investors that they may receive a call from a future prospective investor, right? To say, hey, um, had a great pitch by Kevin. We'd like to see if he's full of S, right? Is everything that he's talking about, is it true or not? And you will likely will want to have prepped your investors and the people that you want to push up for that call. You never want that to be like a surprise, right? Because you want to be able to kind of guide that conversation, right? But again, it's just one of those things that you want to make sure that you're in control of a lot of that due diligence. And at the end of the day, you are in control of that due diligence, right? But during that secondary due diligence call, what they may ask for is a data room. A data room will house all of the pertinent items inside your company that investors will want to see. The first one that's always going to be in a data room is going to be your pitch deck. Okay, that's always there just because we want to be able to issue that data room and let the investor know that you have one, you know what it is, right? The data room can be in a Google Drive, it can be in literally whatever online mechanism or format you'd like it to be, but you want a room that you can share with the investor. In the data room, likely there's going to be the pitch deck. There may be a one-pager in there, like an executive summary of the company of what you do, right? And for more companies that are further down the line, what you also want is a financial deck to say, hey, I have my revenue projections, and right now we're earning zero money, but in 5 years we're going to be earning $1 billion. They're going to want to see why you thought that, right? The financial deck can be fairly simple, but it can be very complex. Completely depends on the company itself. And then finally, if part of your pitch deck includes your education, be very prepared that the potential investor is going to call your college and go, "Hey, did he go to school here? Did she go to school here or not? Did they study in that field that they studied in?" Right? Because that is a very simple way to just gut check exactly what you're saying, and that's a very silly way to fail due diligence. Don't lie on your pitch decks. I don't know why I need to say this, but don't do it. Just don't do it. Right? Make sure that you're in control of all data points at all times, right? But okay, let's say you go through your product demonstration on your secondary call, you go to the data room, you give the investors everything they need. What's the next step after that, right? In your pitch deck, you've had your ask already. You've had your ask already. What you've asked for will likely be exactly what your investor is going to base their decision points off of. Here's an example. If you've asked for $30,000, right, at a 30, let's say a $500,000 valuation cap, they're going to likely either go ahead and give you that valuation cap, or they're going to negotiate against your valuation cap. But what I have seen, generally speaking, is that they're never going to negotiate against themselves. So leaving a valuation cap on your pitch deck a lot of times can work against you because you've already technically negotiated against yourself. They know how far the deal is going to go, no matter what already, because you've already put it on your deck. If you say I want a $5 million valuation cap, they're never gonna tell you, Kevin, you're a great guy. We'll give you $7 million valuation cap. That's never gonna happen, right? So just be careful on how you kind of put that on your pitch deck. And then finally, if you don't put a valuation cap on it or an equity component on it, expect that the investor's going to come back and say, what if we do this? If you ask for 30,000, what if we give you 50,000? What would you give us? And you start ping-ponging back and forth. So that is what you expect on after your second kind of due diligence call, because the first call is we're interested. The second is, are you real? The third one is, what does it look like when we're buying? What does this marriage look like? Right? In that final investor stage, I would highly recommend that you ahead of time have in your heart how far up or down you're going to go. Just have it in your heart and just know that they're going to push your limit. And so if you have that in your mind already, just know that you can approach it a position of strength or weakness. So I'll pause there. I laid a lot on you guys. Any questions from me so far? Yes, Felicity.
Hi. So when it comes to the team and almost selling yourself on your pitch deck slide, I am a first-time solo founder. My education isn't related to what I'm currently doing. I do have some outside experience, but nothing that's sort of provable and that people can check up on. So how would I sort of frame that in a way that is appealing?
Fair enough. And we just also had a very like it's related to your question, which is like this is applied to angel investors, right? When like you say, guys, I don't have much. I have my idea and I have me, and I want to kind of pitch this to to like the audience, and how would they do the due diligence? This is where a lot of warm introductions will become very important. And the reason why the warm introductions become important, excuse me, is that they're relying on their due diligence to kind of frame their investment into you, right? So this 100% applies to angel investors. So in your case, Felicity, and actually I've read through your deck and stuff like that too. What they may ask for is, do you have like a CAD drawing? Can you prove that you have this idea, right? And so their due diligence may be very short, maybe very simple, very sweet, especially at the size that at the size of check that you're looking for. So for angel investors, which is what a lot of we are looking for, right, is when we talk about like, and this is just kind of going along with the questions that are being asked inside the chat, you may say, Kevin, I don't have a financial deck. Do you have projections? And so the question is, after the projections, how did you come up with those projections? That is your financial deck. It can be very, very simple, right? That simplicity for that is very key, because angel investors again are investing in you and what they believe that you can bring to the table. So Felicity, in your case, what the due diligence might actually look like for you is simply to talk to your I believe that you had talked previously about like your traction in terms of like the TikTok influencers, right? That have agreed to speak on your product on your behalf, right? Correct me if I'm wrong. Great. They're going to talk to them. They're going to say, hey, if this is a large part of your deck, then they're going to want to speak to those TikTok influencers and go, hey, they spoke about you on this deck. If that's true, not even if it's true, like, do you think this is going to work and why? So, but speaking to those people on your pitch deck, you want to make sure that they understand that they may be approached for that type of conversation. And this is where they can pitch for you as well. Mark said, can you speak to lead investors versus follow-on investors that close out a round might be helpful for the audience? 100%. So when you're pitching your product, the first money in is the most powerful money, because generally speaking, your lead investor, what we mean by lead doesn't have to be the largest check. It's the first check that comes in that you are willing to accept. The first lead investor that you take in will likely frame the round. This is what I mean. So if you have $1 million round that you're raising for, right, and the first $50,000 comes in and they're saying, I'm willing to invest in you at a $3 million valuation cap, that will likely be the round, or you're not accepting it. So that's something to keep in mind, because every single time you have a commitment from a lead investor or an investor before, the subsequent follow-on investors, their investment has been de-risked. right? Their risk profile is lower now because now they're not investing into a company that has zero money. They're investing in a company that already has previous capital deployment promises in there, right? So your lead investor is always your it is your most important investor. So you want to pick your lead very carefully. This applies all during your angel round. It applies very heavily in your subsequent rounds because the lead investor is likely the investor that everybody else looks to do the due diligence for. Here's an example. What if I came out and told everybody, "Hey, Jeff Bezos invested in my company." Everybody's going to go, "Cool, okay, we'll put money in too." Why? Because you're thinking Jeff Bezos has done the due diligence on this company and said that they're right for investment. So you're rarely going to do any due diligence at all. If they invest, I'm in. That is a lead investor, and that's someone that you want to make sure that you keep kind of close to you at all times. Did that answer the question, Mark? Not a question. You're helping lead the conversation, which is really good. Thank you very much. Does that help kind of frame that properly?
Yep. Yep, I was going to say that's really helpful because, like you said, they can, as you spoke to, they can set some of the terms and will usually take point on the due diligence. And so, that person, either from check size or experience or industry alignment, potentially just means, they want to take point, and then some of the other investors might sort of soft circle, amounts that they want to contribute if the lead sort of sets the pricing, right? Then they'll kind of say, hey, we'll help you close out that round and reach your goal, but we don't want to be the largest check or the person, necessarily doing the initial valuation.
Well, the first one that jumps in, because again, the first one that jumps in is the most risky money that goes in, even though for you it's the most powerful check you're going to get. That's the reason why it's the most powerful check, right? So
Yeah.
in my case, even in my raise, I already have somebody wanting to follow on invest from their previous investment of, let's say, 50 grand. At that point, everybody else already knows that there's an investment of 50K already in there, which is de-risking their investment as a follow-on. Did your advisors? Yes. So my advisors invested in my company, and how I approached them was pretty much what I did for my advisors was I actually approached them as investors first. And so I said, "Hey guys, I have an idea that I'd like your participation in. And the reason why I've come to you is because you have the skill sets or the previous experience or the connections to the industry that I want to join in or have clients in that will really help my company." So what you would do in this case is I approach them as investors first and ask them to be advisors after. You can definitely flip that around, by the way. You can ask them to be advisors first and then ask them to invest them afterwards. However, I found it easier to ask them to be investors first and advisors after because you want them to buy in first in order for them to advise you, right? Or else you're just giving away vested shares for free. So to kind of align your interests, a lot of times what you want them to be is investors first, advisors after, but it can be a flip flop as well, depending on the scenario. When Kaju, sorry if I pronounced it wrong, but Kaju said, when do you know when to open a round and when it is closed? Do you continue until you get your money, or do you have to close it at a certain date? And what does closing mean? Great question. When you open a round is generally when you start first taking your investment calls, right? That being said, if you're already well down the road with like your company and people have already approached you like, hey, a friends and family round could be an example of this. When somebody comes up and says, I want to give you $5,000 for your company because I believe in it. You can take that check. When you open and when you close around that can be very arbitrary, but generally speaking, when you open a round, it's completely up to you. And is when you first start talking to investors and you take in your first check, that is when the check opens the round, right? Because you generally want to have subsequent investor calls with depends on each round is very different, but when you open a round, you want to have investors teed up to pitch to, and you've technically opened your round. A lot of times people consider the round open when you take in your first check. Also, you close the round when you felt that you've reached your targeted goal for the round. So if you want to raise $100,000 and you receive $100,000 in checks, you close the round. That does not preclude you from continuing to raise funds, though. No one says that you have, when you say, I want to open a round for this amount of money, right? And you find a reason to continue going with it, you can technically keep it going. It is completely up to you. You are in control of your round, with a caveat of when you have institutional money, that becomes a lot more controlled because your lead investor is not going to say, you wanted $1 million, I'll give you $1 million, but I want no one else involved. Your lead investor can make any demand and you can reject or accept any demand. This is a negotiation, right? So you open the round when you decide the round is open and you start taking in checks. You close the round when you decide you have enough money or you have the correct people in the correct places and the correct investors in to close the round. You can continue until you get your money, and you don't have to close it at a certain date unless it is a pre-included deal, like deal term with your lead or any subsequent investor, because you could technically have a lead investor that put in $30,000 and somebody else comes in and puts in $150,000, right? But their deal is going to be, I want no one else behind me. The reason is they don't want to get additional dilution, but that goes into play later on, right? So, Kaji, did that kind of help answer that question? Is like when to open, when it's closed, do you continue? And when to kind of stop it? I want to also kind of feed on to beyond that, which is you can also reject money. If you ever happen to be in a position where you're oversubscribed, it means that you've raised a certain amount of money, or you want to raise 100 grand, but you have $150,000 commitments. It's a great place to be. This just means that you get to pick and choose your investors. You go, hey, I have enough money, so I'll take this person's money because they are not a better investor, but they align more with our interests, right? Or if you're very, very savvy and your company's farther down the line, what you can do is, and we're speaking as founders here, you can pit not against them against each other, but you can explain that, hey, person A wants to write me a $200,000 check, but they're willing to give it to me at a higher valuation cap. Well, are you willing to match that? So on and so forth, because at the end of the day, that means your dilution can remain the same while raising more money. Um, Joshua Del Toro asked, do you need to have a business structure in place to open around? Yes. I would highly recommend it. You don't need to, but it does come as part of your due diligence. Um, it can be part of the deal, by the way. You could say, hey, I have an idea now, and portion of this raise will go towards creating an LLC or a C corporation. Those are two of the likely ones that you'll face. You're probably never going to get somebody else like F corporation or anything like that, but it can be part of the round, by the way, to say, hey, this money is going to go towards creating a business structure. You can do that, right? That'll be part of the deal itself, which means if you don't create one, the deal becomes null and void. How do you show traction to a lead investor if you're in ideation stage? This goes back to part of the Ben kind of webinars to talk about traction, as in and Adam and those that have been on the previous webinars. I think we asked ChatGPT of what the tractions are. The traction is kind of on each of those. It's like it goes like what, like actual signed contracts, LOIs, verbal agreements. Then it's like unpaid, it's like a wait list. Um, in Felicity's case, it's also like a TikTok, like TikTok users. Pretty much anything that you'd be proud about sharing about your product, you want to show as traction. So, does that kind of make sense to you? And more so, did that answer your question? Gotcha. Perfect. Any other questions so far? These are great questions, by the way. Keep them going. And those of us who've actually those of us who raised money before too, if anything I've missed, like Mark had like spoken up, about lead investors and follow-on investments, etc. Like, like definitely pitch in. We'll talk more about it. A lot of this comes from my personal experience with raising funding as well as a very hefty due diligence when my company was about to be acquired, which is going to be all your finances, all your tax returns, all your clients, your entire client list, all this stuff. You have to just kind of flesh out everything up to however comfortable you are with the information you're sharing. I want to also reiterate that you are in control of due diligence. You can share what you want to share. Just be aware that if you don't want to share some things, a lot of times the deal won't go through. Gad asked, do you need a valuation if you're looking for angel investing? What you'd want to do is you'd want to at least have an idea of what you want to sit at with your valuation cap. Valuation and valuation cap are very different. A valuation is how much is your company worth right now. When you're doing angel investments, you're not looking at valuation, you're looking at a valuation cap, which is how much will this company be worth down the line. So you're pushing the buck down the line pretty much, right? So a valuation cap itself will be you're capping the amount that your company is going to be worth for this particular investment. So I'll give you an example. If you have $1 million valuation cap and someone invests $100,000, they will eventually own 10% of the company, even if your company is valued at $5 million down the line. That is how they make their money, right? So to answer your question on a very kind of brief sense, you do not need a valuation when you're looking for angel investing. You want to have an idea of what you want as a valuation cap. What you also want to be aware of is your valuation cap is going to directly affect how you raise funds in the future. So you want to give up as little as a company as you can afford to, as well as understand that the investor is going to want to have the largest upside they can get from you. So that balances that negotiation. Does that make sense, Gad? While you're writing that response, Malik, how important are coming from an accelerator to investors? Depends on the investor, honestly. It does help. When you go through an acceleration program, it means that the accelerator has teed you up, likely given you some lessons and taught you how to be a business owner, so it can de-risk their investment, right? So coming from an accelerator, the accelerator will likely have a list of investors that they'd like to put you to after the acceleration process as well. So think about it this way. Anything that de-risks the investment for the investor is something that they like to see. It could be previous investors, it could be traction, it could be you being having a previous exit, right? It could be being in an accelerator, right? Education, anything that if you were to step on the other side and you go, that makes sense, that makes it less risky for me to put in money, that will be important for the investor. Malik, did that help answer that question? Awesome. And what instruments are used for investments, safe or something else? Generally speaking, we look at safes or convertible notes, and those are the two most common investment instruments that we see before Series A, right? You do sometimes have like straight equity investment, right, which is a valuation, but that would generally happen if the investor just simply agrees with the valuation, right, that you're setting on the company. But more institutional investors will want to have the valuation done properly because that has an effect on their taxes. But the instruments that we generally see inside at least this form will be safe and convertible notes. Wow, this cough is never going to go away. I've had this cough for like 2 weeks. But have I kind of helped answer that question as well? And yeah, keep them coming. right? I have about another 5-10 minutes before I have to jump off. But yeah, keep them coming. Or again, if those of us who raised money before have like, insights that we want to give, or, not to call out any investors that may be on the call, right? Like any investors that are like, hey, you may have missed out this. Can you flesh out this as well? Ping it at me, right? I can definitely, cover more of that. Raising at a high valuation can be early. Yes, very much so. So Malik asked, I've seen that online raising at a high valuation early can be bad down the line. It's because it's very hard you can shoot yourself in the foot. So I'll give you an example. Say right now I've got an idea and I've raised $100,000, no, $1 million at a $10 million valuation at just the idea stage, right? And then things don't go very well. And the next time someone comes in and they go, I'll give you money at $8 million valuation. Right now, your first investor is not very happy with you. And you don't want your investors to be unhappy with you, generally speaking. So what the new investor is also going to ask for is your cap table. And they're going to see that you raised money at an extraordinarily high valuation. And they're going to see that someone else valued your company higher before, and you've gone down in valuation. So why are you doing that? It raises a lot of questions. Why are you going down in valuation? Why are you even accepting that? Are you going to do that to me? And that can be a spiral towards low valuation. Yeah, down rounds are a nightmare. Yep. So down rounds are generally definitely a nightmare because there's so much explaining that you have to do to figure out why the down round happened. So be careful with your raises. And if need be, raise smaller amounts of money at lower valuations at incremental chunks. Does that kind of help answer that question, Malik? Like it introduces a lot. We call it a death spiral in a lot of startups, is because then all of a sudden the investor's like, oh, he's desperate. He's very desperate for money. He's gonna keep going down and hammer you on the valuation until you're valued out of your own company. A newsrod asks, yes, and follow up, what are the difference between convertible notes and SAFE? SAFE is a simple agreement for future equity, and it's generally a one-pager that just says, I'm putting money in at a valuation cap at this amount of money, at this amount of valuation cap, and maybe a discount, right? A convertible note is a note that generally includes, it's like a loan with a promise to pay out in the future. A convertible note will likely have an interest rate attached to it that can convert at a later date at a certain percent, at the interest rate that you set on it for the time scale that the convertible note is active for, and they can convert that interest as well into shares. So the main difference between the two is SAFE may not have a convertible like time that it ends. Convertible note always generally does. It's hard to be like always, because I know convertible notes that do not have a conversion time frame, and I know SAFE notes that do. So it's like, generally speaking, one or the other has certain things, but convertible notes generally have interest rates. The SAFE notes do not, and SAFE notes are generally one pagers. Convertible notes are multi-pagers. They're just a mechanism themselves. SAFE notes are every single piece of money, every single dollar I've raised is on a SAFE note. So if you just develop a working prototype from an idea, what will be the next step in finding investors if you don't have traction? Cool. So with a working prototype, a type of traction will be to release that prototype to people around you that will be willing to write testimonials about the prototype itself, why they would use it. That's traction already. Another traction piece can be if you have a prototype and you've launched it on like Kickstarter or anything like that. That's definitely traction. You know what I mean? So I would usually try to find some sort of validation. So what we mean by traction a lot of times is validation of the product. So validation, sales are definitely validation. People have handed you money for your product, that's validation. right? People approving of your product is also validation, right? Um, I have a mentee, and their application, right, um, is in the prototype stage. And what I've requested they do is have influencers look at the product or think about even the product idea. And if they agree with it, I would be willing to evangelize it. That's traction. You see what I mean? Anything that you'd be proud to share about your company or idea or your product is traction. Does that help answer your question? I had
Yeah,
the
it
cough
does.
drop.
Thanks a lot.
Well, my pleasure. And for a physical product, direct to consumer is harder for them to raise from a VC if the product has not launched yet with no traction to show investors. With a similar product, yes. So we just had a question in the chat is number one, if you have a physical product that's direct to consumer, is it harder for them to raise from a VC? Not necessarily. You'll be able to find investors that kind of work in that space. That goes down to, again, finding investors that invest strictly in that space for you. You'll find those. And the second one is if the product has not launched yet with no traction to show investors, would a similar product from a competitor in a different country validate that there are demands for such a product? 100% that has traction. Because again, it is validation that this product is going to work, and it de-risks the investors' money because they show, hey, over there on the other side of the world, they have a similar product. Mine is better. Why is it better? That works for them. They sold $1 billion. I can do the same. Does it help answer the question? Perfect. And Felicity, yep. Tracking has been the easiest thing to be approved because you're excited about the product and you're able to kind of share people's excitement for the product. And that's, again, anything that de-risks the investor, that it will be traction. Let's assume an angel investor gives you 100K with a valuation cap of 1 mil. What does the exit strategy from the investor look like if the company doesn't go public? They can freely sell their shares to other investors. Depends on the shares. But in short, yes. So the note that they have, right, is an investment tool. I don't know if people here trade stocks at all ever, but think about the investment that they've made into your company with a piece of paper that says, I made an investment to this company at 100K at a valuation of 1 mil. And now the company's worth 5 mil, right? But they need liquid capital. They can take that piece of paper with their name on it, sell it to somebody else for however money they want to sell it for, and they can exit out of that investment. It's the same thing as of right now. If I told you, what's a private company that we imagine Uber was still private, and I was like, hey, I have a piece of paper here that says that I have the right to Uber stock. I have 10% of Uber at $1 million. Would you buy that for? You see what I mean? That's one way to exit out of that. They can also no, they can't take loans out of that. But they can freely sell their shares to other investors. However, sometimes in a convertible note or a safe note, it requires the permission of the other safe holders past 50% to make that sale, right? Because other shareholders may also want to sell their items. So you want to take a look at the terms and conditions of your safe note or your convertible note to ensure that it is good to go. But generally speaking, the investor will have that onus on them. Did that help answer the question, Fabio? That being said, though, I've never personally seen an investor want to sell their position in a company that's doing well, unless something huge happens. But I've very rarely seen it. That being said, though, when you go from safe and convertible notes and you convert at a Series A to actual equity, that is a conversion event that they can definitely sell their position in because you value the company at that point. Somebody else can buy it at that valuation. So to kind of further on to this, 100K, $1 million valuation cap. You go to Series A, company's worth $10 million. That is a conversion event, right? You own 10% of that company at that moment in time, plus or minus dilution. You can now sell that portion of the company to the Series A investor if they want to. Be careful. You want to take control. Okie dokie. I got time for maybe one or two more questions if we have them. But if not, I hope this is very helpful for everybody. Awesome. Thank you, Alex. Thanks, Felicity. All right. With no additional questions, thank you, everybody, for your time. I hope these webinars are proving to be helpful, right? Yes, Alex.
I just want to say thank you, and I appreciate that you use like realistic numbers for people that are learning this process. The normal flim flam of you put your name out, you think about raising $40 million in checks come in, is usually what you hear with this stuff, and it's nice to hear on the down and dirty because this has been, and I've been successful at the raising, and it's been the most demoralizing experience of my life. So thank you for talking about this with real numbers.
Yeah, my pleasure. And yes, I want to let everybody know fundraising is tough. Have thick skin. If you have a good idea, you want to share it, you want to think, and this is my final tonic comment for everybody. You have an idea. Your thought process going into a pitch should be, I have a great idea, guys. I'm giving you the opportunity to make money. I can make you a lot of money. Take that excitement in, right? People will feel it from you. Hopefully they'll want to invest in you, right? On that note, thank you, everybody. We'll chat in the next webinar and have a great day, evening, morning. Have a good one, guys.
Thanks so much.
Thanks,
Thank you.
Kevin.